Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I am going to show you when not to use the option collar strategy with your money, and I am going to talk about NUGT, ticker symbol NUGT. Now NUGT is an ETF, a 3x fund on the Gold Miners Index, and in case you're interested, this is a chart of the Gold Miners Index. The Gold Miners Index is very much like the Dow Jones or the S&P or the NASDAQ. There are lots of different indexes out there. The Gold Miners is one of many, and it's an index that measures performance of all the gold mining stock companies, and this is NUGT. It is a 3x fund on the Gold Miners Index, and that means that if the Gold Miners Index goes up, let's say 2%, then NUGT's going to go up 6%, 3 times the daily performance. And of course, if it goes down 2%, then NUGT will go down at 6%. That makes NUGT a very volatile stock, or I should say a very volatile investment. So you don't want to be doing an option collar strategy on something like this. And I'm going to start by talking about a video that I did several months ago, and I called it Great Short-Term Growth Strategy for the Conservative Investor, and I talk about how to sell covered calls on volatile stocks, ETFs, and I picked NUGT as my case study. And there you see I circled in yellow highlight. One of the people who watched my video asked me a question. He asked the question, why didn't you use the option collar strategy? And I gave him a very short answer. I didn't go into any depth. The option collar is not a good strategy on NUGT because it is a leveraged ETF, and the premium on the put options is sky high. Now, the leveraging ETF, I already explained it, makes it very volatile, and that's not a good thing for the option collar strategy. The option collar strategy is a buy and hold strategy, and if you have something that is really volatile, then you might want to go the day trading route. And the sky high premiums on the put option means that if the stock goes down, or I should say the ETF, then the put option isn't going to move that much. I think the delta is hovering right at around $20 on NUGT for the $20 strike prices, and so that's not a good thing for the option collar. It makes it very expensive. Okay, now this here I find to be both hilarious and sad. I did exactly what I told that person not to do. I bought 200 shares of NUGT at the share price of $25.41, and this is all on February the 20th. Today is March the 10th. And on February the 20th, I bought 200 shares of NUGT at $25.41, and then I bought 2 put options at the $20 strike price, and I spent $870, which is very expensive. And yes, they expire in 2 years, January 17, 2020, but $870 for a put option with a strike price that is more than 25% out of the money. So right off the bat, NUGT needs to go down more than 25% before that put option is going to see some real appreciation. And then I sold my 2 cover call options at the strike price of $33, and I got $121 for April 20th, 2018 expiration, which was at the time about 60 days away. And that partially enticed me to get into this because I thought that's really good money. I can easily pay off this put option, blah blah blah, right? Well, it's not as easy as you think, as you will soon see. Okay, now here's the numbers here, and if you want, I'll go back. You can pause the video right here, and you can add up all the green numbers, add up all the red numbers, and then subtract the red total from the green total, and you will see that I lost money. Or you can just look at my little spreadsheet here. I keep this in Excel, and there in the lower left hand corner I lost a total of $643.03 from the day of February the 20th, 2018 to March the 6th, 2018. That's about 2.5 weeks of time frame. Okay, so what went wrong? Let's find out what the heck happened and why did I have to lose that money. Okay, well, right here is a chart of NUGT, and that little blue arrow points to the spot where I bought NUGT. Okay, that red candle is February the 20th, and that is a 1-day candle. and I pointed the arrow, I tried to point it at the $25.41 price as close as I can get it. This is all just guesstimate, but that red candle is the total price open to the price close. Green candles mean that the stock went up for that day. Red means that it went down for the day. And you see the little skinny lines, that means that it went actually higher and lower than the open and the close. Okay, but the main body shows the open and the close, and so that arrow points to where I bought the shares. And then I also bought those 2 put options, and I sold those 2 call options. So right now I'm feeling fine. I'm thinking, okay, this is good. I'm getting $121 for those $33 strike price call options, and I'll do really nice. And if Nugget did go to $33, then I can make a nice 30% return in 2 months, right? Sounds like I'm dreaming, right? Well, the next thing I did, and I circled it here, already on the 27th, I had to do some money management. So I bought back my 2 covered calls for April 20th expiration at $33 strike price for $47, and I sold some $27 call options and I got $41, and those ones expire on March 16th. So I bumped the expiration date, but the strike price, okay, I started out selling $33 calls, and now I'm selling $27 calls. Now I'm taking an actual risk, because if Nugget goes over $27 between now and March the 16th, which is when they expire, then I lose money. Why would I lose money? Because I bought Nugget at $25.41. If Nugget goes over $27, then what could happen is my shares get called away, my call options get exercised, and I make money on the shares. But remember, I spent $870 for those put options. That's why I had to sell the $33, okay? 25 plus 8 is 33, and then you add that $121 and you get $34.21, right? And that would pay for my put option, but $27 strike price doesn't even come close. And so if Nugget went over $27, then I would lose money on the put options, all that money that I spent on the put options. So that would not be a good thing. So I'm taking a real risk there, okay? Why did I do that? Well, right here, back to this chart, now you see I put in a second arrow. That second arrow is on the 27th of February, and look at the difference, okay? Nugget is dropping. I buy Nugget at $25.41. Nugget is now dropping in the $23 range. So I bought 200 shares, so I'm down $2 a share times 200. I'm down $400, right? So I'm thinking, well, I better take advantage and I better sell some calls before it goes down any lower. So that's why I did that, right? And again, this is a little blue arrow. That's a real concern for me, okay? Selling those lower strike price call options creates an upside risk for me, which means I can lose money if the stock goes up. Imagine that, but anything's possible with these stock options, right? So real concern there, okay? And then the next thing I did, and notice this is only 4 days later, I had to do another money managing move. This is on March the 1st. 4 days later, I sold 4 call options at the $26 strike price, going even lower, and then I bought 4 $40 call options because I don't have level 4 option approval, so I have to do spreads. I can't just do naked calls, which is probably a good thing, because then I would have lost even more, okay? So why did I do that? And another thing is I'm selling 4 call options. I only own 200 shares, so I am over leveraging myself, and there's nothing wrong with over leveraging yourself per se as a strategy, right? But to do it on something like Nugget can be very dangerous, because if Nugget pops over $26, then I start to lose a lot of money, okay? And if it goes, and remember, if you look here, I sold the 26 calls and I bought the $40 calls. If Nugget did go up to $40, I could lose well over $2,000. So again, you know, the risk, and I could feel it at the time, the risk is going up, and my blood pressure is going up and up. I'm thinking this is getting from bad to worse, right? The risk is going up. I don't like that. Well, here's the reason, okay? Now you see a third arrow. Look how low the price of Nugget is, okay? Nugget is all the way down. It opened under $22, and I don't know if you can see it, but I put a little red arrow down there. There's a little skinny green line that says that Nugget went all the way to the mid $21 levels, and there's a real danger when Nugget drops here, and I want to show you this and explain it. Okay, this is a 5-year chart of Nugget, and I put 5 little blue arrows that you see there. Each of those arrows points towards a little black box with the letter S in it, and those little black boxes with the letter S stands for all of the times that Nugget has done a split or a reverse split. Now, when the price of Nugget goes high, then Nugget will do a split. So let's say you own 200 shares like I do, and Nugget does a 4-to-1 split. Well, now you have 800 shares, and that's a good thing. But if Nugget goes down, and it loses value, and Nugget goes to $20 and then to $15 and then to $10, it will do a reverse split so that it doesn't turn into a penny stock and it loses its liquidity. So let's say it does a 4-to-1 reverse split. Well, if you own 200 shares, well, guess what? Now you own 50 shares, and you're not going to be selling any covered calls when you only have 50 shares. Okay, so that's a real concern there. So that's why I did this. That's why I sold those. So I thought, well, if Nugget's just going to keep dropping, then I am going to make darn sure that, and again, this is me trying to save a losing position, which is a very bad habit in general. Okay, the best thing to do is to get out of the losing position and get into a winning position. Okay, it isn't to try to save a losing position. You make a bad move, then just get rid of it and get into something fresh. Okay, and so the next thing I did, and again, this was 4 days later, is I closed the entire position. I bought back all my short calls, I sold back my put option, and I sold my 200 shares, and now I'm out completely and I'm all cash. Why did I do this? Well, here's the reason right here. Okay, I circled it. Nugget kept going up, and I was getting nervous that it was going to hit that $26 strike price. Maybe I could have rolled it out. Maybe I could have did a lot of things, but I would rather get into something that I'm comfortable with. I felt like I was over my head. I don't like playing ping pong where the stock goes down, uh-oh, I better sell more call options. Stock goes up, uh-oh, I better roll it out, or whatever. I don't like doing that. That's me trying to save a losing position. I'd rather just get out of the losing position and get into a better position. Okay, so that's why I got out. That little red circle, you see there that Nugget has been going up, but it did have a little red candle, and it did neutralize at the end of this last week. Again, today is March the 10th, and today is Saturday. The market closed yesterday. That little green candle, so it's that little green candle shows Nugget kind of neutralized, but there's really no telling what the heck Nugget's going to do. It's so volatile and so unpredictable. It's really hard to predict, and I really take my hat off and props to anybody that is skilled at day trading and knows how to use technical indicators and be able to buy on the dip and all that kind of stuff. So again, I got out of my position on March the 6th, and those are the numbers right there. Here's the final tally: a loss of $643.03 from February the 20th to March the 6th in about 2.5 weeks of time. So things to remember, okay? Number one, the option collar is a buy and hold strategy with low risk. So if you don't like diversifying, I do not believe in diversification, okay? And there are several reasons why I dislike diversification. I would much rather just pick my favorite stock that I think is a good stock, put all my money in there, and then just protect myself with an option collar. Okay, that's way better. I get way better performance than I do putting my money into 10 different stocks. You know, and think about this: if you're diversified in 10 different stocks, and one of the stocks goes to the moon, it goes up 20%, but all the other stocks stay neutral, and some of them maybe even go down, then oh wow, you're up 2%, but because you only diversified. But if you had all your money in that one stock, you had an option collar, then you'll make decent money. That is a fact. You will make decent money. Okay, Twitter is making me a lot of money. I have an option collar on Twitter, and I'm up like $1,500 on Twitter. That's another reason why I decided to kind of get a little, I don't know if you want to call it gambling, but why I took a little chance with Nugget is because I've been doing really well. I've been having a really good year with Twitter, right? Well, now that good year, it just got kind of cooled down a little bit, and I took a little small $600 loss, but I'm out and I'm ready to start fresh. Number 2, the option collar is a bullish strategy, and you saw NUGT is not a bullish investment. NUGT is a leverage ETF, and it will lose value over the long haul. All leveraged ETFs lose money over the long haul. The reason why they lose money is because they are leveraged with contracts, swaps, futures, straddles, etc., etc. And every single day, all of those contracts, all those positions have to be rebalanced, and that comes out of the value of the ETF. And even though it's volatile and you can make a lot of money, you're not going to make a lot of money doing a buy and hold strategy, and it's very hard with the option collars. Not the recommended strategy. Okay. Number 3, check the prices on the option premium. If you're going to be spending $800 for a put option, or $870, then those put options should be near the money, or maybe even a little bit in the money. Okay, $800 is very expensive, and you know, to spend $870 for a $20 put option on a stock that's worth $25.41, that's just a little wee tad expensive. Okay, and when the stock goes down, I mean, it has to go down 25% before that put option starts to see some real gains. So it's not even hardly worth it to do an option collar strategy when you're buying put options that far out of the money. Okay. Number 4, it is better to add to a winning position than to try and save a losing one. This one is a no-brainer, and I'm going to move on to the last one. Okay. There is no one-size-fits-all strategy. Okay. A lot of people have their favorite strategy, and if you've been watching my videos, then it doesn't take a rocket science to know what my favorite strategy is. It is the option collar strategy. But what a lot of people do, and I guess I can include myself, is they have their favorite strategy, and then they pick a stock that they want to make some money on, and they say, okay, I'm going to get this stock, or I'm going to get this ETF, and I'm going to do the option collar strategy. Well, it doesn't work like that. Okay, the right thing to do is to look at the stock or the market overall, and let the market tell you what kind of strategy is the best. Now, NUGT is a leveraged ETF, so day trading would be probably a good strategy, or swing trading. Okay, but why would you buy a put option on a stock that you know is going to go up? Now, nobody knows what stock is going to do what. Okay, but if you're going to buy a stock, an ETF like NUGT that goes up and down like crazy, like a trampoline, okay, then don't mess around with option collars. Okay, use stop loss orders. Okay, buy a stock, you know, buy some NUGT, pick a price, and put in like a trailing stock or something. Put in like a 2% trailing stock. You know, have some kind of a setup, have some kind of a system you use. You know, put in some level of support, or maybe use some moving averages, and then put in a little trailing stock. Do something like that. You know, don't mess around with these put options. Okay, don't be spending all that money on these option collars, because it's not worth it. It's so hard to make back the money that you spend. And you saw like how I was bouncing back and forth like a ping pong ball, because I'm thinking I'm losing money, I better sell some calls, and then it's going up, uh-oh, what am I going to do, right? And you're just kind of reacting to the market. Okay, and you don't want to do that. Okay, you want to be in control as best as you can, and the way to be in control is to have a good plan and to use the right strategy in the beginning. Okay, don't use a wrong strategy and then try to and then you're losing money and try to save the losing position, right? So there is no one size fits all strategy. A lot of people, they have their favorite strategy, but it shouldn't be like that. Okay, you should pick the strat. You should try to learn as much as you can about as many different strategies as you can, and then just pick the best strategy in the given market conditions. Okay, so those are the things to remember from this video. Those are the things that I guess you could say are takeaways. Okay, so that's it for this video. Don't do an option collar strategy on NUGT. I won't say don't do it, but I don't like it. I don't think it's good. If you have any questions or comments, feel free to leave a comment. I'll do my best to answer that question. Thank you for watching. I hope you enjoyed this video, and I will see you in the next one.